Ilan?
Yeah, thank you, Shani. I'll take over. At the outset, I'd like to thank Srini. He was my senior in RP Center, and he was known to be a bespoke person, be it with the case or with anything else. I've attended most of your thing or seen the recordings of the videos. They are exceptionally good. When he called me, he said, talk about your experiences about instrument purchases, ophthalmic equipment purchases. Now, this is the only field probably in entire medicine where even a beginner, even if he has to start a small clinic, has to invest so much. All other specialities, probably with a stethoscope, BP apparatus, and a pulse oximeter, they start. So today, we are going to talk about hospital equipment purchase, loan versus IOL bundling, depreciation benefits. That's the topic given to me. And whatever I'm going to talk is with my experience, what I've gone through. Like I said, all kinds of loan I've taken. Most of the kinds of IOL bundling also I have encountered. Now, first, what are the things to be considered while buying an equipment? Of course, you should know what is the equipment you're going to buy, what are the other options of that equipment available, and is there any lease model that is available? Very few lease models are available, at least in ophthalmology. So let's come to purchase. Now, number one is, of course, this down payment, what you have to pay, irrespective of the kind of loan or financing you are looking at. The whatever required is the down payment. Next, if at all, if you're going for a financing option, be it from the bank or from the company that you purchase the equipment, you need to pay a monthly payment. So remember this. Are you capable of making that down payment? Are you able to service this particular loan? And third, most importantly, 80% or to 90% of a private practitioner's business comes from intraocular lenses and OPD. Specialties, well, they constitute 10 to 20% only, except in big hospitals. So the biggest consumable that we use is an intraocular lens. We have varied type of intraocular lens. We have varied type of surgeries. If you get locked into, can you shift to other lenses? How many of these lenses you have to use? So you have to have this in the mind. And finally, owning an equipment. Yes, all of us can hire a Uber or a Ola, but then owning a car has its own advantages. Similarly, you can get it on a loan lease, if at all, if possible, but owning the equipment gives not only depreciation, but also some kind of other intangible benefits. So the question here is whether we're going to buy it with money or the IOL bundling options. Now, again, though we say only two different classifications, I would like to classify this into four, wherein you have enough money to buy the machine outright. Definitely, this is not the case with a beginner. But an established practitioner with someone in the background, with a good background, can do this. Next comes the bank financing, which Mr. Nitin spoke about so well. Also, there are two types of IOL bundling. The first one, I'd like to call it as an additional premium. I've used these words. I didn't get these words anywhere else. The second is, of course, without any premium, you can still buy this machine. So these are the four things that we are going to talk about. The first one, buy upright. Then again, all these four options I've classified under four different headings. The initial payment, upfront payment, monthly commitment, your control over IOL option and cost, and owning the equipment, that is the depreciation. So when you look at it, the things in red in all these presentations are relatively bad. Things in green, that's not green, whatever teal, whatever color, they are very good. And blue is moderate. This is how I classified this. So you can look at it. Upfront payment, if you're purchasing it outright, is very high. But no monthly commitment. You can decide on what intraocular lens you want to use. Tomorrow there's a cheaper lens available in the market. You can shift to that. And yes, you get a 10%, at least 10% depreciation year on year for your equipment, and you own this equipment, so you can operate at will. This is the advantage of buying it outright. Control over IOL options, cost, and depreciation owning the equipment is the same if you get a bank loan. However, most of these banks, like Mr. Nitin was talking about, need at least a 20% down payment from the person who's buying it. Sometimes this goes up to 30% also, depends on your financials. Though Srini was talking about 8.8, 8.5% loan, these are for large loans, is what my experience is. If you go for an equipment purchase, starts from 9.5. That is what I've used for calculation here. Later on, I'll be using a calculation and comparison. 9.5 till 14%. What is this 9.5 to 14%? 9.5, you can give an additional collateral. 14% without collateral, not banks. There are some financial institutions, NBFC, which tie up with the instrument maker. He gives the collateral, and then, he is the collateral rather, and they give you at around 12 to 14%. I've taken these loans also, 12%, not the 14%, but I hear there is a 14% loan also. Now, what is this additional premium? It is similar to a loan, but you can easily see on that presentation, upfront payment can be nil if you have a very good relationship with the company. But for a beginner, usually they ask for again 20 to 30% initial payment. Some of them reduce it to 10% if you are really good. And if you are well established, even a zero payment is possible here. But instead of an EMI, which has EMI plus interest, here you'll be paying a monthly installment, which is only the principal. There is no interest. The control over the IOL options is less. It's not completely zero, though I put it in red. It is less. Yes, we happen to own this equipment. We have to ask for this. There are some people who will not allow you to own this equipment, some companies, but you have to ask for it and get it in the agreement that we have to own this equipment. It is possible here. Now, how is this extra payment that is calculated? It's very simple. You should know your total number of cases, or at least approximately total number of cases. Whatever is the cost of the equipment divided by this total number of cases into so many years. Usually when this is tied up, it is 3 to 5 years. In a loan, I forgot to mention, it can be till 7 years for your equipment. Usually again, it's 5 years. So I've used 5 years for calculation for all of them. And so this extra money is taken, say you purchase an IOL at say 8,000 rupees. Now this extra money is added and say you're purchasing the IOL at 10,000 rupees. What is the advantage you're going to get here? Number one, this 10,000 you're going to consider as an operative expense. Number one. Number two, as soon as the machine comes without paying it in full, you have a bill. So you can consider this as a capex. So this is the advantage here. Now let's come to no premium. No premium is the machine comes to you free of cost, or that's what you think. No upfront payment is required, or some people ask for a moderate payment, maybe 20, 30%. Let's keep it for calculation's sake. But monthly commitment, there is no EMI, no interest, but there's a huge collection in terms of numbers as well as the cost. You cannot control this. They give you an X number, you have to use that much at X cost, which is usually the market value, but all of us know market value is highly variable. And if you use more, they give discounts. That discount, you cannot utilize it. And you cannot own this equipment. It's usually owned by the company, and the company transfers it to you at the end of X years, usually again 3 to 5 at 1 rupee rate. I have bought one equipment like this in the initial stages. And how much of IOL do you have to buy from them? Or consumables? Let's use the word consumables. Sometimes IOL, sometimes very rarely something else. It is usually 4 times the cost of the equipment. Some companies give it at 3x, 3 times the cost of the equipment. So this 3 times or 4 times the cost have to be covered up in 3 to 5 years. Now think in your own mind whether this is possible by a beginner. Again, the calculation for that, how much on each lens, again is how do they get the money? That 10 or 20% discount, what they give when you buy it in bulk, that is how they make this money. So these are the comparisons. Now, if I have to align this in a, okay, also there is an intangible benefit. If there is an additional premium or no premium, the company usually services this money very fast because they need to sell their IOLs if there is a downtime in the machines. But if you buy the machine, again, they take their own sweet time. So if you are, according to preferences, if you put it down, less number of red on the top, that is buy outright. Even at this stage, I don't buy any equipment outright. Additional premium comes second because there is no interest in it. You also happen to own the machine. The only disadvantage is control over the IOL options is relatively less, not completely no. Still, you have some options, relatively less. Then comes the bank financing. Bank financing, I have added interest. The other things are positive. Upfront payment is relatively higher when compared to an additional premium. But what we forgot to mention, and what my previous speaker also probably forgot to mention, is there is a hidden cost in this bank financing, which is called a service fee, ranges from 0.1 to 1.5% depending on which bracket of that interest you fall under. So again, that is an extra money you're going to pay to this bank. Then there are a lot of other indirect costs like registering your loan, all these kind of things if it's a heavy loan. Now, when it comes to no premium, there are only two greens. That is no upfront payment, maybe no monthly commitment in terms of money. But then look at the two different things. You don't get your depreciation. You don't own the machine. You don't have any control over the IOL option. Usually huge numbers are given to be covered in shorter periods of time. And then this is possible only by an established speaker. Now herein, I brought in a model where the cost of the equipment is 32.5 lakhs, wherein standard 7.5 lakhs is used as a down payment, which is approximately around, say, 25%, slightly more than 25%, slightly less than 25%. Interest rate, I've taken it as 9.5%. 9 to 9.5 was the least I was offered. That's why I've taken this. Tenure, 5 years across all the things, though the tenure might vary. And I thought as a beginning, even if you can do 10 good surgeries in a month, that would be great. The other thing, when you go for additional premium and no premium bundling, usually this bundling is not for the lower category lenses. They fix a particular lens and say any lens above this price is what you have to buy. When you start the practice, this is not the case. What we get as lower budget cases. So I've used 10 lenses per month. IOL cost considered as 8,000 and discount applied to this IOL 10% if it is bought in bulk. Now all these cases we're going to buy in bulk, right? So I use that 10% discount. It's only not used for the last. So look at the first line, buy outright. The only negative is that 32.50 lakhs, but that's a huge negative for a beginner. No monthly EMI, just 10 lens usage per month. That is 80,000 minus 10% discount, 72,000. This is the outgo if he does 10 surgeries in a month. Again, second additional premium, 10 surgeries, but then the person has to pay 41,667 rupees towards the cost of the equipment per month. This is added to the IOL bill. Yes. So you can get the benefits, but this is an extra payment that you have to pay. So it becomes 11,36,067 rupees is the cost per month. When you go for financing, you can look at it that it is 52,505 because there is an interest component that is added. For practical purposes, I use the same kind of lens, though you can remember that in these three cases, there is no absolute, in the first and third case, there's no absolute need for using a lens, but in the second, you will have to use a lens. So 72,000 again, so it's 1,24,505. But look at the last example. These 10 lenses are not enough to cover that premium of 25 lakhs, what you have left out. So you have to use almost 17 lenses, 17 of these premium lenses for these people, minimum. This is only for a calculation. Sometimes it's not 17, it's 40 to 50 lenses per month. So practically, this is not possible for a beginner. The rest of them we can consider. Now look at the last two lines. That is the depreciation value and the value of the machine at the end of the this 5-year period. The machine value is still good in the first three cases. Last case, usually they transfer it at 1 rupee at the end of the period. So there is no value for this machine and no depreciation you have claimed. This is the disadvantage with the last one. And in the second one, that is additional premium, you have to negotiate with these people to transfer the ownership to you. Some of the companies, even in additional premium, do not give you ownership. They claim this depreciation and transfer again at 0%. So this is possible in an additional premium. With a no premium, less chances. You can still ask for it. That is why I've aligned it in this direction. So how do we proceed? First of all, you have to think about which machine to buy, not only which machine to buy. Are you going for an outright purchase or bundling? And what are the other vendor options? Sometimes you'll be thinking of one vendor, the other vendor might be giving it without a bank loan at a reasonable amount. I've had interest-free EMIs even for 3 years from some vendors. Some small vendors, they give it. They just want to sell the machine. And they give very good service also. Also, think about the volumes that you can generate. It has to be conservative or the least possible. Of course, you can be optimistic over a period of 3 to 7 years. Here we have used 5 years period. And then compare this. What should you compare? Normally, when you tie up with these people, there's a fixed rate that is planned, and later on, if there is a discount on this, they don't pass it on. So while it is possible with a bank option and self-financing, this is not possible with IOL bundling options. So you have to make sure that in the agreement, there will be an agreement that is signed, two kinds of agreement. So in the agreement of purchase, you have to make sure that you say this is given on the whatever the market price is, and whatever that market price you have to specify there, or with so much premium, whatever that is. Build a cash flow model. Your CA will help you to do this. Go and talk to him freely. Tell him this is what you can operate at this rate, and this is the expense required for the machine, and whatever you're going to charge. And then finally, do a sensitivity analysis. What is the sensitivity analysis? Almost all businesses, this is how you take the average, do a minus 20%, minus 30%. But I would give you a better example. We know that ophthalmology business fluctuates throughout the year, and this is one of the leanest months, at least in Bangalore. So take this leanest month as an example and then calculate to buy a machine. Also, negotiate, look at the downtime risk, service SLA, that is a service level agreement, sign it properly, how long they are going to give service, training to your staff, how many times. If you buy the equipment, they usually do it once or twice and charge extra for next visits. But if you happen to have an IOL bundling, they do it as many number of times as you want. And then whatever option you go out for, particularly in the IOL bundling, ask for a resale value. At the end of the 5 years, the machine still has a value. So he has to transfer it at that rate if he is holding the ownership. Then finally, most of the cases, what we do, at least in metro setups, now almost 80 to 90% is reimbursements, insurance or government service or whatever it is. See whether this government service and insurance allow you to use the premium lenses at that particular rate. Because if it is IOL bundling, he's going to fix a particular type of lens. Anything over and above that you can do, but not below that. The next step is how you negotiate with these companies. Take an exact IOL set, ask your friend, define the premium lens segment, whichever lens you're going to put it in writing there, what you're going to use, at what rate you're going to use, and if there's a change, how is going to support it. And then write the minimum purchase obligations. Now herein, this is what I tell, the rolling minimums, meaning the least number of lens in this month, whatever I use is what I use to deal with these people. This is the leanest month, I told already, for me at least. So if there is a price escalation, how do you manage this? You have to cap this when, if at all, if you're going for a bundling option. And if you're terminating this agreement for whatever reasons, I don't want to get into the name of the company. There was a company which had an issue 2 to 3 years back with their lenses, and many of them had a agreement with these companies. So that particular thing has to be terminated. When it is terminated, most of these companies in the agreement would have written that they can take back the machine, but you have already paid towards the machine if it is particularly more than a year or two. So you should make sure that you enter this in the agreement, that you'll pay the remaining money and hold ownership of that. You should be given a chance and X number of days to pay the money because you can't generate it immediately. And look at the service agreements. Normally, we get 1 year comprehensive maintenance or warranty, 1 year. And then usually the companies give one extra year for this kind of IOL bundling. Or some companies, particularly in the last category, till that 5 years, the company takes care of the equipment. Make sure that these are written down and kept with you. Also, whenever you buy these consumables, it has to be on a consignment option as and when used, not on a monthly buying business. Because if you keep on buying monthly, I've had this issue also. The lens pile up, they do not exchange the lens after a certain period. At the end of the contract period, I have already told fair market value should be given for the machine. Termination clauses and penalties, probably you can consult a lawyer. Training, upgrades, and software as and when required or when a news person comes. Some of the machines, such as the fundus camera or where the patient record is stored there, make sure that this record is with you, not the company that has given you these things. And we should be able to audit so that we can decide about it. Now, two things: what to negotiate, if possible, shorter exclusivity, meaning they also put in an exclusivity, particularly for beginners, saying that we have to use only their IOLs. So have it for shorter exclusivity, saying the first 10 or first 17, whatever you're booked for, is taken care of. The remaining is I'll buy it from outside. And if the option should also be that if I use more lenses, the period should reduce and I should be given an option to close it. Consignment, we have already spoken about. The third one, performance-based discount. All of us would have seen that if you purchase 10 lenses, there is no discount. If you purchase 20 lenses, we give you 5%, and then if you purchase 50 lenses, we give you 10%. Here we have assured them in a year that we're going to purchase a minimum of 50 to 100 lenses or maybe more. So we should ask for this performance-based discounts, service guarantees on the loaner equipment, and transparent invoicing. Some people add indirect costs like the banks had here also. So what are the red flags where you should not get into this? If they're asking for a large number of lenses, recently there was a person who came and asked me for 11 lakhs of lens purchases per year for that particular equipment. Directly I turned him down. Hidden fees for disposable. Some of these, all of us know that many of these machines runs on cassettes or tubings which are disposable. So you have to calculate that also. We should cap all these things, because if we do not cap the purchases of these disposables, they may increase it anytime. Ambiguous buyout terms. That's why I said put it down. What is the buyout term? What is the termination term? And if they say you can finish this as 100 lenses, we're just going to add 20,000 per lens. Please do not get into this, because that bill may not be valid even if they give it. So we started with this. What are the thing for a beginner? I would advise, in my opinion, bank financing is for a beginner. Probably additional premium you can think of. Definitely additional premium will come at a lower cost, but then a beginner should know that he has to operate the 10 or 20 or whatever the numbers are fixed. He can also negotiate for a smaller numbers in the first year and gradually progressing numbers. So that normally what happens is, if the number is 10, probably fix for 5, and in the last year give that back to them. And the person who's already made money, pregnant, is going to start a second setup. He can think about any kind of options to buy this equipment. Thank you for the opportunity provided.
Thank you, Len.
Excellent presentation. I think
yeah,
we have covered most of the points.
It's a comprehensive one. Juniors can actually go back and see whatever. But probably one thing that Ilan, you missed out is, see, when you calculate on bank financing, the interest that comes in the loan can be considered as your business expense.
Expenses, correct.
So
correct.
it is not 9%. It'll come down to much lesser than that. That interest effectively would, and then how would be the calculation? If you're coming in the 30% bracket and you're having a loan for...
no, you can claim everything because it's a business. You can claim
No, not
exactly.
like that, sir. Sir is telling how does the effective tax rate work on your interest rate.
Yes.
Say if you are paying 9% interest per annum, and you come under 30% slab, your interest is your interest payout will be 70%, because you get the 30% income tax benefit.
Yes.
You will have to pay lesser tax on the interest payment,
Yeah.
since interest is claimed as an expense from your income.
Yeah.
So essentially, instead of 9, you will get 7%.
But then
around 6 point.
Around 6 points, between 6 and 7.
6 and 7, yeah.
Yeah.
Yeah, depends on, no, if you are in 30% slab, but as a youngster, you will not be in a 30% slab.
Yes.
Your effective rate may be 0% tax if you are within 12 lakhs. So you will have to see that how it works for you.
And second thing, if the machine is owned by you, you're already claiming 10% depreciation, Shani.
No,
So
for first year, I think it is 15%, and then it becomes
yeah,
10%.
I said minimum of 10. Minimum.
Minimum, yeah.
So that way, bank finance is a good option if you can go for it.
Yes, definitely.
Especially for beginners.
No, what I compared was bank finance with IOL premium.
Yeah.
And in my opinion, IOL premium is slightly better for two reasons. Yes, you said interest can be utilized, but there, the IOL premium itself comes, even the principal what you pay there can be claimed as your expense.
Yeah, premium will be entirely expense
Yes.
in your P&L.
Yes.
So there also you get the effective tax rate
Yes.
benefit.
And one more is the GST
And
credit
but you
also.
don't get the depreciation. That is it. Your premium expense is offset by your depreciation.
Yes.
Yeah, I just want to make one point, Ellen, very good
Yeah.
comprehensive. One is, though you have emphasized, I will want to re-emphasize. One is the cost of consumables and hidden costs, which also include your annual maintenance. And
Yes.
even in the annual maintenance, it is labor free only, consumables or any part gone. Invariably, what a small part gone, they'll charge you 1 lakh, 2 lakhs and all these things. So at the end of the day, mm, I know it is different for different people. It's very difficult for us to say. But at the end of the day, if you want to go for any IOL bundling or additional premium, doubly look, triply look into the clauses, especially the exit clauses, as you said, consumable costs. Sometimes what they do is they give you a slight waiver here and add on the consumable costs there, and which the consumable, because we tend to overlook certain things, all of this here, and most importantly, the rules of the AMC. That essentially how you compare is you go and ask a person who has bought outright, because the person who has bought paid money by full down payment, you would have definitely got all the best options here and try to match your bundling to those options. I think that's a fair way of going about it in case you want to go for IOL bundling.
Yes.
In the case of outright purchase, we'll have to explore even the returns that you are making from the money without investing in the
Yes.
machinery.
Yes.
Yeah. If you are making good returns out of the money invested somewhere else, you are losing that opportunity here.
I think the ballpark figure is 18 months return on investment. I think you can go for outright purchase. If it is a long term, then you can look at all the other options.
Depends on